Hi there, Sean Kevelighan here with the Triple I. We've been saying for some time as we look at economics at the Triple I very closely that we're in unprecedented times with our inflation and other circumstances. We are beginning to see some of those barricades kind of lift a little bit, but at the same time, we've also been saying that there could be things that trigger the economy to go in a different direction. And certainly one of those is the debt ceiling debate that we're currently experiencing. You might recall the last time that we had this type of debate was 12 years ago. And at that time, arguably, we were just getting ourselves out of the financial crisis. However, this particular debate also put us back into an economic downfall insofar as we also then materialized the likes of Occupy Wall Street. So this debt ceiling debate is an important one, and I'd like, if I could, to bring in our chief economist, Dr. Michel Leonard, to talk a little bit about this with me and what it means for our industry. So, Michel, as you well know from your economic history, that we've been here before, but maybe you can also walk us through what the options and the steps are that the administration could take in terms of the debt and defaulting.
Absolutely, Sean. Thanks for that question. As we're recording this, it's unfolding out there. We have reports that maybe there's a breakthrough, maybe there is going to take a few more days. We don't know what's going to happen there, even those principal in negotiations. So what we're trying to do here today is to give a sense of a roadmap, looking at the past and looking for guidance as to where we go from here. I look back, and over the last 30 years, we've had almost 20 different types of government shutdowns. They've gone as long as 35 days and sometimes as short as a few hours. Traditionally, the way these unfold is that once we reach the impasse due to the debt ceiling and the inability to issue new debt, the government will start in the first phase, I would call it, like 1 to 10 days, to slow down operations. And that means slowing down the routine organization of different departments and so forth. But folks are still employed. The government is still functioning. After 10 days, things start to get a bit more severe, significant. This is when employees are furloughed. For example, 800,000 employees in the last big one that you were referring to. This is when the TSA may stop having to be being paid, and folks being asked to come for free and so forth. So as we progress, there is more significant impact. Now, this points, as you said so correctly, Sean, to a multiple steps that Treasury can take to prevent default. And in the past, we again have gone as much as 30 days without getting into this step of default because Treasury has operation. It can move around money, then it can stop paying folks. And in some considerations, employees have to keep coming into work. Either it's on a rotation basis or on a fully unpaid basis. So there are multiple steps. And if we haven't gotten to that yet, but then after those 30 days, there are situations where Treasury could explore, speaking with the Fed, looking at alternative forms of funding, etc. So there are multiple steps that can take place. And I think even if conversations were to break down today, causing significant instability, it would be unlikely that we are getting to the actual threat of imminent default 30 days, up to 30 days from now, based on previous history. Now, Sean, you, in your past experience, were in both the White House at one point and at Treasury. Would you mind giving us a sense, for those of us who haven't been privy to that kind of environment, of how do communications go back and forth, whether on a regular, ongoing basis, but also during times of crisis management?
Well, depending on the circumstances and situation, various parts of the administration can be a priority depending on it. But I would say economic performance is always at the top of the list, one way or another, in terms of a metric of the performance of an administration. So the Treasury Department is a big part of that economic team for the president, and there is a regular dialogue beyond these types of circumstances where that dialogue does increase. There's a reason I think that the Treasury Department's right next to the White House, insofar as I haven't seen it, but I understand there's even a tunnel between the two buildings. So they need to have that important relationship. There are entities within the White House, the Council of Economic Advisors and the National Economic Council, that are also part of that team. And of course, the Commerce Department is a leader. But what happens in these circumstances? They certainly stay very close. The communication, both the principals, the president and the secretary, will stay in close contact, but also those supporting staff, making sure that everybody understands what this means. Factor in as well the Office of Management and Budget here as a key part of that team. So as a crisis like this unfolds, you can imagine that they will probably be setting up what you will call a war room, even to make sure that they're in constant dialogue and understand what the circumstances are, and they're ready to be prepared and deal with it. But yes, the Treasury Department is a very important part of the economic team for the president, and I think the economy, again, overall is an important measure. So the president wants to get this right so that we don't see any lag in economic performance. And of course, having a Congress that's on the other side of the political spectrum of the president means that there's going to be this is now a political mechanism, which is probably the most unfortunate part of it all, but certainly what's been happening. So I do think we again need to pay very close attention to it. We have seen it before impact our economy, and I would be willing to bet that the Treasury Department and the administration's economics team are working throughout all the day and night right now on this. So Michel, just to wrap this up, give me kind of your final perspective on this. What do you think the implications are and what they might mean?
Replacement cost and growth. At the end of the day, the more uncertainty, whether or not we go to 5, 10, 20 days, or we're a shutdown at all, this signals to the market a dysfunction in terms of government operation, and that leads to higher interest rates potentially down the road, which fuels inflation on their own and reduces growth. So for us in the industry, trying to get out of a situation with difficult replacement costs, cumulative replacement costs, trying to catch up on growth with the rest of the economy, this adds to those challenges.
Yeah, and those replacement costs, we've got a new normal, which one of your charts recently pointed out. You got to look at year over 3 years on replacement costs, and they're high. Personal homeowners replacement costs, construction materials up 55% year over 3 years. We've got auto replacement costs up 45% year over 3 years with an average of 40%. So this is a new normal, and we're not going to see it go down. If inflation goes to a negative, we're in an even worse place than the high place we are right now. So more to come. Stay tuned to Triple I for further information on this. Thanks so much.